Good afternoon, everybody. My name's Michael Ward. I'm a partner of FWO Chartered Accountants, and welcome to this afternoon's webinar on cash flow management. And once again, thank you for your attendance. Cash flow is a vital part of any business. Many people in a business think immediately that profit is what's the most important thing. But the reality is that running a business is like a dual-edged sword. You have to not only monitor and ensure that you make a profit, but you also have to make sure that your cash flow is positive, or that you have sufficient cash resources to continue to operate into the future and fund growth and expansion strategies that you may be wanting to implement to develop and grow your business. We've actually seen instances in the past where profitable businesses have actually failed because they've run out of cash. So that really exemplifies the importance of not only measuring profit, but also keeping an eye on cash flow. And as I said just previously, in any business, we're always trying to grow and expand. And normally with those growth and expansion strategies, that will have an impact on cash flow. In a simplistic sense, we have to understand that without cash, you cannot, for example, pay out profits to owners, find cash to invest in new products for your business, pay your expenses, or purchase new assets, or pay your liabilities. And without sufficient cash, you won't be able to achieve your business goals and objectives. So keeping an eye on cash flow is extremely important. And as we said, cash flow is the lifeblood of a business. So if cash flow is the lifeblood of a business, then financial management systems are the heart, the arteries and the veins that pump cash around the business body, so the business operates without falling ill with disease. There's two core financial management systems for any business. That's having a profit and cash flow plan and ensuring that you've got timely and accurate reporting on profit and cash flow. So we'll explore both these areas in more detail. For a business to be successful, it must ensure that it measures its profit and cash flow monthly. Although in some cases it might be more preferable to do it weekly or daily. And also it's important to ensure that financial information is accurate and provided in a timely fashion, so that the key decision makers in the business are making decisions about the future for the business and strategies to implement based on sound financial information that is correct. We've often heard the comment from clients in business that you tell me my business has made a significant profit for the year, but how come it doesn't show in the bank account? What that statement shows, or that question reveals, is that a lack of understanding of the difference between profit and cash. And in most businesses, profit will never equal cash. I've set out here a couple of equations which might make it a little bit easier for you to understand. But firstly, profit. The equation that determines profit is your business income less your business expenses equals profit. Whereas what determines your cash at bank is a completely different equation. It's cash inflows less cash outflows in that same period, plus or minus whatever your opening cash at the beginning of the period was in your bank account. So hopefully those two equations give you some sense of understanding that profit and cash are determined by completely different components. And so you need to understand that profit will never equal cash. And I've given some examples here, so it sort of magnifies or explains it better why that is the case. For example, you may make a sale to a customer on credit. So when you make that sale, that's when you report the revenue in your profit and loss statement. But the client may not pay you until 45 days later after the sale based on credit terms of it. So the cash flow or the money being received into your bank account doesn't happen until 45 days later. So there's a clear example of where profit is not going to be recorded necessarily in the same accounting period as when the money hits your bank account. Another example is where you incur an expense in your business, but you may not pay the supplier or the creditor until 30 days later based on terms that have been offered to you. Once again, in a profit and loss measurement, the expense is recorded when you incur that expense, but the cash paid from a cash flow recording position is only recorded when the money is paid out of your bank account 30 days later. So once again, profit will not equal cash at the same time. Another example is when you have a loan and you make principal loan repayments. Those loan repayments are a physical outlay of cash that will deplete your bank account in any period, but those loan repayments have nothing to do with the measurement of profit or loss through the profit and loss statement in that same period. Once again, profit doesn't equal cash. Another example is when owners make periodic drawings of cash out of the bank account against profits that have been made either in the past or in current periods. Those drawings are not recorded through the profit and loss statement as an expense. They are recorded on the balance sheet as a depletion of the equity accounts. So they have nothing to do with measurement of profit or loss, but they very much have an impact on the balance of the cash at bank balance. If you decide to use cash in a bank account to buy assets of the business, that will have an impact on deflating or depleting the balance in your asset account or the cash at bank asset account on your balance sheet. But that purchasing an asset is not an expense that you would record in your profit and loss statement as a measurement of profit for that period. Once again, profit does not equal cash. Making payments of tax periodically during the year is another withdrawal or a depletion of your bank account. But again, it has no impact on measurement of profit, which is revenue less expenses. You may draw down a loan and bank the proceeds of those loan proceeds into your bank account. That has an impact on cash inflows and your bank balance, but it's got nothing to do with measurement of profit. You may sell some assets, and similarly, the cash from the sale of those assets will get banked to your bank account as a cash inflow, will boost your cash balance as an asset, but has nothing to do with measurement of accounting profit in that period. Owners may contribute further funds into the business by an equity injection. That will have an impact in the cash balance by improving it, but it has nothing to do with measuring profit or cash. So hopefully those few examples I've just discussed clearly demonstrate to you why profit will never equal cash sitting in a bank account. And just to further illustrate this issue, we've got this little cash flow diagram that summarises a position from when you incur an expense to either buy a stock item or incur an expense in your business. It may be 30 days later that you pay for that stock item or incur the expense. You may then have another period of 15 days before you make a sale to a customer, and then it may take a further 45 days for that customer to pay you. So in this situation, or in this example, the time between purchasing stock or an expense item and receiving the cash is 90 days. The fundamental focus of any profit and cash flow plan is to ensure that the time between receiving the cash for a sale and the payment for the purchase of that stock item or that expense item is kept to a minimum. And the ultimate aim is to receive cash before you purchase the stock or expense item. In other words, you get paid for it before you have to pay your supplier. A couple of little examples to amplify that point. If you build a house, the builder often will require a deposit when you sign the contract. So in that situation, the builder is getting some money up front before he starts doing any work and incurring expenses. you might buy a new pair of shoes from a shoe store and you have to pay cash for that stock. But the shoe store owner may have that stock on credit. He may not have paid his suppliers yet for it. So he's going to get cash for the sale before he has to pay his creditor. Or you are going to go on a holiday or a business trip and you pay for your plane tickets before you actually get on the plane. We all have to pay for our tickets days or weeks before we actually utilise the service. So the airline is being prepaid before they've delivered a service. So in understanding that cash flow is the lifeblood of any business, we really need to make sure that we develop a profit and cash flow plan for the business. Because a profit and cash flow plan will help you understand the impact of the cash gap that the cash gap has on your business. And we always recommend that a profit and cash flow plan is prepared for every business annually. And the plan should be done by a person who is responsible for the expense area of financial management in your business, who has a clear understanding of the business expenses that your business will incur and the margins you make on sales and revenue. The profit and cash flow plan needs to be supported by 12-month action plans for each revenue and expense area of the business so that it supports the projections that you're putting in on expected revenues and expenses. And it also supports what strategies you're going to implement to decrease the gap between when you derive net revenue or profit and when you receive the cash. The ultimate aim in any business is to increase your profit and reduce the cash gap. Your actual results as you go throughout the year should be measured against the projections on a monthly basis. And you should recast your projections on a quarterly basis based on what's actually being achieved, because the projections that you initially set may be unrealistic given the current conditions and circumstances in the particular marketplace your business is operating in. And similarly, whatever action plans that you set for achieving your targets, you need to report on them and update them each month and measure them against the key outcomes that are actually being achieved. We call these key outcomes the key performance indicators of your business. It's extremely important in measuring cash flow or keeping an eye on the cash flow in your business to ensure that you've got timely and accurate reporting. So you need to have a very strong internal financial management system. And these days it should be computerized. So it fastens your ability to access up-to-date, current and accurate information. And what that internal financial management system should produce for your business is an accurate balance sheet and an accurate profit and loss statement. It should also be able to provide for you a list of customers that owe you money and details of how much they owe you and for how long they've owed it to you. This is often called an aged debtors list. It should also be able to provide a list of suppliers that you owe money to at any given time, which details how much you owe them and for how long you've owed it to them. And we call this an aged creditors listing. It should also be able to provide you a list of employees' pay and entitlements you owe to them, such as holidays and long service leave. And for those businesses that have trading stock, it should be able to provide information on what stock items you have bought and sold during the period and the cost of what stock you have on hand at the end of that period. There are a lot of really good low-cost business software packages now available for business owners. So you should ask your accountant to advise you what's the best software package that's going to best suit your business needs. I've just got here on some slides just to give you a bit of an idea of what a profit and loss and cash flow projection model looks like. This is a dummied version of a make-believe company called ABC Proprietary Limited, where we've got a profit and loss projection done on quarterly basis. This particular software we use is able to drill this down to month by month, but just for the sake of this exercise, I've made a report on quarters so that it can be seen on the one screen. But the profit projection sets out sales less direct costs coming to gross profit, less your overheads coming to your operating profit, then adding other income to determine your earnings before interest, tax, depreciation, then claiming depreciation and interest to come to your profit before income tax, less income tax expense, depending on what type of entity you are, coming to your net profit after tax, which then flows obviously into your balance sheet. In this model here, I've not dissected the different assets that are made up in the categories of current or non-current assets, but the software that we've got enables us to drill down to item by item in those categories. And so total assets less total liabilities shows what your net asset position will be at any point in time in the future based on your projected profit and loss statement. And that further flows into what impact the difference between profit and cash has on your cash inflows and cash outflows. That determines what your net cash movement is for that same period based on your projected revenues and expenses, and also your projected capital inflows and outflows that would impact on balance sheet items, going back to those examples I gave you earlier in today's webinar. That's all factored into this cash flow projection so that it shows you the impact of, or the difference between cash flows and inflows, and what impact that will have on the bank balance at the end of each quarter, which obviously then flows into what the balance sheet is showing is the cash balance at the end of any quarter on the balance sheet. So that's just to give you an idea of the type of reports that your business should be producing so that you can keep an eye not only just on the profit of your business, but also on the cash flow of your business. So it's important to remember that your accounting or your internal financial management systems needs to be reporting on accurate and correct data and information. Otherwise, it's a case of garbage in will equal garbage out. And if the reports aren't accurate and correct, then you're going to be making poor decisions based on incorrect data. And poor decision making leads to a dysfunctional business. And a dysfunctional business means that you'll probably not meet your profit or cash flow goals, and could also mean that you make some very poor decisions about the future, which may get your business into trouble. So hopefully today's webinar has given you an insight into the importance of monitoring both profit as well as cash flow, and that both are equally important in maintaining a robust and successful business. So I'd like to make an offer to the first 10 people that have participated in today's webinar. The first 10 that email me at michael@fwo.net.au will receive a free 45-minute phone conversation with me, exploring the opportunity to review your profit and cash flow plan in your business. So thank you for attending today. I appreciate that you've made the effort to dial in and listen to today's topic. So hopefully you have found that interesting, and those that want to take me up on that offer, please do. If you've got any general queries or issues, you can email me at michael@fwo.net.au. So once again, thank you for attending, and I look forward to you joining me for my next webinar. Thank you.